if they don't do this willingly, the gold price will easily exceed $10,000 to $20,000 per ounce before any form of equilibrium is reached.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire. Welcome to Live from the Vault. Welcome to Live from the Vault, brought to you by Kinesis Money. And as you can see, I'm in the vault today, right? And Live from the Vault, by the way, is the show that goes way beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis's very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering a few more of the questions that we received from the Live from the Vault community. So keep the questions coming in by just clicking the link below. We'll just include the link below, and you can record your questions to Andrew directly on our voicemail, and that's option. So you never know, your question may be answered on our call here live. So let's go ahead to the UK and talking gold with the one and only Andrew Maguire. Now, Andrew, it never ceases to amaze me how quickly these market updates come around. And once again, everything that you estimated way back in our first episode, January 2025. Everybody go back and watch January 2025. One step at a time, everything that you've said is being fulfilled right now. So the bulk of our subscriber questions, coincidentally, really center around your gold reevaluation expectations. Can you bring us up to date or up to speed on what you're seeing here?
Yeah, great to see you, Shane, back in the vault, friend. And yeah, great to be with everyone. Let's get to it. There's so much to get through. But yes, there's been some very understandable skepticism around US gold market revaluation. That because we had the same kind of skepticism when people were doubting that the Bank of International Settlements would revalue gold as a first-year high-quality liquid asset. So I'm going to update and run through the gold revaluation footprints we're now evidencing, along with the most likely dollar gold price expectations. Now, I'll also provide some end-of-year realistic silver targets. Now, bearing in mind, the bulk of our information gets distilled through the largest liquidity providers, physical liquidity providers, who see both gold and silver grossly undervalued versus gold and silver that broke out months ago into all-time highs. So let's start with gold. Just as the Bank of International Settlements inflection point where they revalued gold as a first-tier high-quality liquid asset drove a race by global central banks to swap fiat currency assets for physical gold, just 33 months later, gold price in dollars is currently $2,000 per ounce higher. So net out the intra-month legacy market volatility, and gold has averaged out a very quiet, stealthy, relentless $60 per ounce rise in price. This relentless gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by a massive bid-only margin call or a US Treasury gold price revaluation. So now that global physical exchanges have become sufficiently liquid to benchmark a real supply demand gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. And we'll kind of look at those footprints. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has been driven into all-time highs. But as we've been focusing on, the real game changer is that China took the gloves off the moment the yuan gold price became fully Basel III compliant. Now, the fact that this is still unnoticed by the mainstream media, these are the analysts who try and form fit news releases, interest rate drivers, these kind of things which influence the paper market actors greatly, but they completely miss the underlying race by central banks to swap dollars and associated fiat currencies, this whole range of fiat currencies, for physical gold. But here's the key: at any price. They don't care if it's higher or lower, they are accumulating. And with the Basel III compliant yuan-backed gold price being benchmarked through a growing network of physically backed SGE exchanges, Western-facing, Beijing is stealthily assuming the gold convertibility mantle. The ease of hedging the yuan price against all other FX currencies, bonds, etc. And so the PBOC is rapidly usurping the dollar as the global hegemon, ultimately forcing Basel III compliance on the last holdout, non-Basel III global central bank, forcing an imminent gold price revaluation. Now, little noticed by the mainstream media is that enabling the PBOC to directly benchmark physical gold against US treasuries, it unlocks vaulted bullion to be used as financing collateral within the entire BRICS system and facing the West. Now, gold is pouring into these Western-facing gold vaults. And simply, so how it works is this gold simply swaps hands completely outside the legacy system in the vaults underpinned by Basel III compliant yuan gold. The gold doesn't leave the vaults. Hence, there is no dilution when it moves around, no volatility when it moves around. And as we summed up in our last episode, with the SGE gold price also seamlessly interchangeable with Western central banks' underpriced legacy COMEX exchange gold, that gold is being drained, incentivizing every single global central bank to race to swap more fast depreciation dollars to buy the same ounces of gold. Now, the White House understands US Treasury gold is once more under attack by foreign central banks, much like it became under attack when Nixon in 1971, when Nixon took the convertibility of gold versus the dollar. This is tectonic, and so really the only tool that's left in the Fed's gold price suppression bag of tricks has been completely usurped. If those prices do not begin to reflect a real physical supply-demand price, every single ounce is going to get drained. It's no coincidence that Treasury Secretary Bessent is currently demanding a full Fed audit, which includes the 8,133 tons of Treasury gold being stick-handled by the Fed. Now, we talked about it a long time ago. It's gone off. It seems to have disappeared under the radar, what was going on. It's on the front burner. Even Bloomberg was talking about that this morning. So it is on the front burner. This would be the first full audit, trusted audit, that would fully inspect all of the vaults, but it was also uncover the extent of double ownership claims on US Treasury gold. Bear in mind, a lot of it was lent out. Now, this has to be concluded before the US gold GRA account, the gold revaluation account, can be marked from $42 or 8 billion, which is current prices, now verging on at real market value at $1 trillion. So 8 billion to $1 trillion in a click of a mouse. Now, obviously, this revaluation process itself would drive gold significantly higher than current prices, and that would provide a healthy buffer when it's revalued. Now, if the White House does not move to revalue soon, there won't be enough bullion to meet delivery obligations, which risks triggering a force majeure condition, in turn driving global prices into a bid-only condition, forcing the Fed to become a price taker at much, much higher prices. Now, they can print their way out of it, but it's going to drive the price higher. And as we previously assessed, at best expectation, the optimum time to revalue gold would be directly after the COMEX December futures contract runs off the board at first notice day. Now, first notice requires all long or short derivative bets to either pay up or stand to deliver on the 28th of November. Now, while this could contractually allow deliveries to be affected by the last day of December, because it is a December contract, the revaluation event would force every single ounce outstanding to be physically delivered ahead of the 1st of January 2026. Now, given the current structure, this would in itself require buying a lot of gold at market in the interim.
Well, Andrew, thanks a lot for that. It makes a lot of sense here. We also had, by the way, this week, a lot of subscriber questions that are asking what we should expect in the very short term here.
Yeah, so Shane, I know, as I say, I know there was a lot of subscriber questions on this, especially as really the mainstream media pundits have, for the last $1,000, the last $1,000 move, they'd be warning gold was overbought already $1,000 ago. But what they're not getting is that the COMEX has become a price taker, not a price setter. So let's delve into the charts for a sec. Now, very short term, and I just want to say we're recording this ahead of FOMC. This is Wednesday, the 17th, and it's about an hour and a half before FOMC. And essentially, you know, as you say, we always expect speculator froth to be rinsed out from time to time. And we see it, but it's very shallow. And it's driven by algo-driven conditions into events like, as I say, FOMC today. But this is constructive, as it quickly finds levels where central banks and sovereigns anticipate these specs to actually be rinsed out. Spoiler alert. As we will see, these paper-driven dips are very, very shallow, resulting in a series of higher, physically supported stair steps to rally from. Now let's take a look at current conditions and how that provides clues of upcoming prices. Now, bearing in mind that this is a COMEX, this is the COMEX or the futures chart, and this is the overbought, so-called overbought conditions. Now, as I say, the legacy actors operating in so-called overbought market conditions have been unable to rig historical wash and rinse cycles, and they've been forced to become price takers step by step by step, and even more so now. And why? Because they're being caught. There's a bunch of margin calls coming in, i.e., the brokers are saying, give us enough money to support your short positions. Now, given every single global central bank followed the BIS in hedging their national fiat currencies and related bond holdings with physical gold. That's what's going on. And it left the only non-Basel III compliant Fed, the only central bank still short of gold. However, the imbalance is about to be rectified, and the only way to do this is to revalue U.S. Treasury gold reserves from $42 to market. Now, given there's an empirical evidence that U.S. Treasury gold is to some unknown degree rehypothecated, which is a view widely held by very well-respected institutionals, and that follows the embarrassing, glaring delivery delays and vault audit refusals that were given to the Bundesbank. So as a result, foreign central banks are actively repatriating their gold holdings from the interconnected US Loco-London synthetically diluted legacy vaulting systems. They're not trusted. Goodness me, if you went to your vault and you asked to have your bullion back, you'd be there with your arm out and they'd be telling you, oh, you can't have it. It's and you can't even see it. I mean, what would you do? You would ask for it. Or I remember Harvey Organ years ago going to Scotiabank and basically asking to see his gold, his vaulted silver, and ended up they wouldn't show it to him, and it ended up he had to call the RCMP. There was in Canada, and the RC, and once they went in there, they found it was gone. It was somewhere in Asia. These numbered bars were somewhere in Asia, so it clearly been lent out. So obviously there's no trust in this system. So what this does, really, where we are is there are two primary questions, which are how much unbacked, unallocated physical gold has yet to be bought back at market into competing central bank demand. And the other question is, given this at market demand is in itself going to drive the offer to sell a bullion, immediately deliverable bullion, that is, T+1 deliverable bullion, significantly higher, at best estimate, what is that aggregated price? So that's what we're going to do here. And it's a constantly changing picture. That's why we want to keep you up to speed as to what all our liquidity providers are seeing and how to best distill that. Now, obviously, given the true global supply-demand data was deliberately concealed after the COMEX gold market was launched in 1994, and enabling the remaining 8,133 tons of treasury gold to be secretly leased, sold into the market without a forensic audit. We just simply don't know the residual degree of rehypothecation, double ownership. So some clues are there, though. In February 2023, the Fed refused to allow the German Bundesbank to inspect their holdings of the New York Fed vaults. Now, this led to the Bundesbank request to immediately repatriate the first 300 tons of their 1,350 tons deposited after World War II. I mean, a lot of it was in the 50s and 60s, but after World War II. And these were numbered bars. However, instead of, when requested, instead of saying, okay, we'll fly these 300 tons out, it's a technically deliverable T+0, really it's in the vault, it should be in the vault, you should be able to just hand it over, or get it securely moved from a BRICS or Loomis truck into the airport. So really what you should be is 12 days, which is normal. We see this kind of silver being shipped around in 25-ton lots. So really 12 flights, 25 tons, should have done it. Yet they were talking about a 7-year T plus 2,555 day delivery process. This is ludicrous. It's beyond credible, but if the records are there, that's exactly what they actually wanted to do. Now, this spilled the beans on just how short of gold the CME LBMA cartel were. They were caught out. Now, this first central bank delivery default, this was a delivery default. It raised a major red flag that the entirety of the published or unaudited US Treasury gold holdings were likely double counted or rehypothecated to some degree. And while an embarrassed Fed scrambled to cut the timeline to repatriate German gold, when it did arrive in Germany, these bars were discovered not to be the same bars as originally deposited. In fact, the mix of bars included newly minted bars mixed with some 1930s 22-carat melt gold, further proving the original Bundesbank bars had been sold and were being repaid in the form of a shell game shuffle. So let's have a look at the charts. Now, while this fast was playing out, and I'm going to focus right on this circle right here, it was no coincidence that during exactly the same time, the LBMA, ABN AMRO Bank, they sent out a letter on the 1st of April that was sent to one of our clients stating they would have to be cash settled on their bullion redemption request. With their permission, we published this letter. With the client's permission, we published this letter, and this drew a horde of fresh physical delivery requests, uncovering major cracks in the LBMA's ability to deliver on their 100-to-1 leveraged unallocated gold holdings. In fact, it was a Reserve Bank of India report in 2010 that actually talked about 98-to-1. Now, over that Easter weekend, right where the arrow is here, a hastily called presidential meeting was held with all the major bullion banks. This was followed on Monday, the 8th of April, with the commencement of a major officially driven $600 gold intervention, and there's no other word for it, a gold market intervention from driving the price from $1,600 to around $1,000. Now, it concluded, guess when? On the 31st of December, 2015. Now, following Nixon decoupling gold from the dollar to halt foreign central banks redeeming physical gold against debasing dollars, these sort of derivative gold market interventions were made possible by launching the paper-settled COMEX gold exchange. We talked about it more last time. And that really, the COMEX was geared up to do what it said on the box, namely what the 10th of December 1974 WikiLeaks memo had revealed, the ability to create as much paper gold as may be necessary to dilute and manage, so-called manage, the gold price. And we saw lots of them. But these paper-driven COMEX LBMA interventions continued until the BIS short-covered all the remaining 500 tons of their derivative gold bets 1 month before revaluing gold as a first-tier, high-quality liquid asset on the 1st of January 2023. It's in your face. The reason I bring this up now is we're once again at the critical inflection point where the entire Western-backed, cash-settled CME LBMA unallocated gold market has broken, but the COMEX price-setting mechanism is what's really broken. Because they've been forced to become price takers. This time, every single central bank, sovereign and bullion bank are long physical gold, leaving the Fed as the only central bank short of gold. Now, looking at the scope of these underwater positions, we can see the Fed is being forced to short cover. We can see that step by step by step. Feedback from our physical-facing liquidity providers provides invaluable evidence the Fed is, as best as possible, short covering into rising physically driven prices. This is also evident in the largely unwatched OCC, Office of the Comptroller report, which we went through over the last 2 or 3 episodes, which actually list the unallocated precious metals, foreign exchange, over-the-counter gold and silver positions that directly relate to and are no longer able to be physically hedge the rehypothecated US holdings because they're being demanded for delivery. And now we've previously looked in detail at how these 20% haircut LBMA unallocated bars have been coming into the global crosshairs for delivery. And it's why we have observed agent bank, JP Morgan and Citi closing all their decades of Fed-held 5-year and longer derivative bets. We said at the time, look at it. This is a massive clue they are covering, and there is going to be a revaluation. Why would you cover? Those 5-year and longer bets have been in place forever. Now, while the short covering process is underway, as we will see, the ultimate upcoming revaluation settlement price is exponentially rising. Now, let's just look at the latest footprints. Okay, for these footprints, we're going to look at the futures chart. As expected, as evidenced in the Bank of International Settlements August swaps report, and thanks to GATA's Robert Lambourne for keeping us up to date on this BIS information for years now. And what he uncovered was the Fed continues to try and square its underwater BIS gold lease positions. And what we're seeing, this is into a series of higher and higher highs. Now, he uncovered that 4 tons was short covered here into this end of month squaring event. Now, that last 4 tons was squared $160 per ounce higher than the July settlements. Bear in mind, we're talking 4 tons here, having to be squared $160 an ounce higher. However, that still leaves 30 tons of bullion to buy back, and even higher, where we are currently, over $350 per ounce higher price than in September, than where they started to cover the first 4 tons of this 34 tons. So putting this into perspective, into real numbers, it cost them $20.5 million. But that had to be exchanged to buy back underwater leases last month. And what did that do? It drove the price in itself higher. But with the remaining 30 tons now facing a $350 higher price, and perhaps more, it will require another $3.5 billion to buy back the remainder. There isn't enough physical gold on offer at current prices to absorb $3.5 billion of additional physical gold demand. It's just not available at these prices. And while the Fed is able to print the necessary cash to square and repay these lease bullion borrowings, and they have been for a long time, and this is the spot chart as opposed to futures, they can no longer be washed inside the siloed COMEX derivative markets, meaning as price takers, they're having to go to market in the spot market to buy physical gold at the market price with their freshly printed dollars. So let's look at who they're running up against. Without exception, we have direct evidence that every other global central bank, sovereign, and institutional buyers are competing to secure physical gold. Now, with all the bullion banks also encouraging their clients to buy physical gold, this aggregated demand versus what we at best estimate is actually made available for sale, this prices gold some possibly over $500 above our January the 1st estimate. If you remember, we'd estimated that by the end of the year, we'd be hitting 4,500. It likely places the price. It could place the price $500 higher than that. It seems far-fetched, but so it did when we started out at the beginning of 2025 at these levels here. So liquidity providers don't expect this global gold demand to taper off anytime soon. And this places the Fed stick handling the 8,133 tons of US Treasury gold in a position where it would be far better to revalue gold sooner than later. Now, following the ECB announcing in June that gold overtook the euro as a global reserve asset, Mohammed El-Erian, very well-respected guy, he's discerned for the first time since 1996, foreign central banks now hold more gold than treasuries. Now, while that assessment was quickly challenged by the Financial Times, their analysis finally conceded that more recent incoming data confirms global reserve managers are moving out of treasuries into gold. Even taken at face value, this evidences one of the most significant global rebalancings we've ever experienced in recent history, and it will force the Fed revaluation hand. In fact, when weighed up against unreported monetary gold purchases, the real picture begins to emerge, and it's not gone unnoticed by the White House. Now, we looked at the Goldman Sachs assessment of this one here of unreported central bank gold purchases. We looked at it a couple of weeks ago and how this is actually grossly underreported. Now, while they noted these unreported central bank purchases were picked up after Russia's assets were frozen in February 2022, what was missed was that this central bank buying accelerated following the Bank of International Settlements revaluing gold as a first-tier, high-quality liquid asset on the 1st of January 2023, which was a bigger story. For reference, net of paper market dilution, when including direct doré buy imports that, as we talked about, disappear in those 42 district Chinese customs districts, that feeds into 678 a customs matrix. And liquidity providers say this is largely military gold, by the way. And so just based purely on real global supply-demand fundamentals, these liquidity providers now update their estimate that the real unreported central bank monetary gold demand not captured in Goldman's assessment is closer to 45,000 tons. Think about it. That's a lot of tons. This is not yet priced in, but it still jives with our end of year minimum $4,500 target. So bottom line, even discounting the extent of how offside these US Treasury holdings are, just looking at what the Fed has to buy back at market to repay the BIS, there is just not enough above ground gold bullion being offered anywhere close to current prices to enable the Fed to buy back rehypothecated gold positions. If the US does not move to revalue US Treasury gold quickly, which is simply a GRA accounting mechanism that would allow them to price gold from 42 to market, balance the books while joining in the upcoming gold price appreciation upswell, getting on board what all the other central banks are doing, enjoying, relishing a rising gold price. If they don't do this willingly, the gold price will easily exceed $10,000 to $20,000 per ounce before any form of equilibrium is reached. The incentive is now. US reserves are at their lowest levels in 90 years. Now, this divergence will force the White House to revalue gold. Now, currently, the value of US gold reserves is about 2% of Treasury outstanding, compared to roughly 17% in the 1970s and actually close to 40% in the 1940s. Now, at 17%, it places gold at around $25,000. At 40%, $50,000 an ounce. Now, I'm not saying that is, I'm not saying that's going to happen overnight. Of note, with silver now recategorized as a critical mineral needed to power AI, far more importantly, silver is militarily being stockpiled by Russia, China, and then we need to vend in reports of US exports being banned. So that is what we're hearing, in conjunction with silver miners being included in a $5 billion US rare earth investment fund that our liquidity providers assess that gold silver cross will actually put the gold silver ratio at 33-1. This is exactly where it was, slightly above where it was even into the November 2011 lows. So given on aggregate all liquidity providers we face also jive with our minimum spot gold target of 4,500, that easily places spot silver at $140 per ounce by January 2026. Just that alone, let alone everything else we were just talking about. Now, when gold is revalued, it's anyone's guess where silver will be priced. But as a critical mineral, it'll be in the hundreds of dollars per ounce. And we'll look at some more immediate prices for silver shortly, but let's just finish up on other supporting gold footprints. And then we'll look at some more, which we're going to look at some mainstream media reports, which are filtering through to influence continuing gold accumulation. Yes, that will inspire some speculators, and they will be rinsed, but it is actually now becoming a major gold. People are recognizing gold as an asset class, and it's underinvested. Also, as Bloomberg reports here, drawing attention to gold surpassing its inflation-adjusted record 1980 highs, liquidity providers report large CTA buying coming in for the long haul. This ETF buying is only just beginning. So with gold prices now being benchmarked through a growing network of physically backed SGE exchanges, where the yuan price is one-to-one backed by gold, we're about to evidence the next pivotal gold price revaluation event, which will once again incentivize every foreign central bank to race to swap more fast appreciating dollars to buy the same ounces of gold. Now, with the Basel III compliant yuan back gold price, assuming the gold convertibility mantle and the ease of hedging the yuan price against all the other foreign exchange currencies, bonds, etc., the PBOC is rapidly usurping the dollar as the global hegemon, ultimately forcing Basel III compliance on the non-compliant US-facing gold price, forcing a gold price revaluation. Last week, the Bank of America Hartnet reaffirmed our existing liquidity provider expectations that yield curve control is driving fresh safe haven gold buying. Now, Hartnet was urging his clients, quote, long gold into YCC and stay lower yields, PKO, and Fed credible rate cuts equals broadening of stock market via bond sensitives, biotech REITs, and small cap. Talking about going long gold. Also, updated this week, he notes, quote, the noisy gold bull will rise further. Also, Hartnet adds weight to our assertions of an inevitable revaluation of gold reserves, etc.
All right, Andrew, you just touched on my favorite topic a while back there with silver and why it's going to keep on rising into the end of the year and even beyond. Now, to answer some more subscriber questions, what are you seeing for silver in the shorter term?
Thanks for that. Yes, good question. And it is a very popular question. So let's jump in on the charts here. Looking at the shorter term action, silver has broken out and it's game on. Magnetic for interim consolidation at $53. And this is leading the way higher, also leading the way higher for gold. Now, we looked at this monthly chart last time, noting the very large COMEX spot short stops that are populated at 44,275. That was the August 2011 levels. Now, these stops, as we said, are of sufficient size, really, to easily drive a run into this 53 level, which is really an aggregated level that a lot of our liquidity providers are assessing and betting on. This just being the next staging post. So you can see how we circled this, I think, a few weeks ago, and slowly, each of these circles have got filled. And now we expect these stops to get tackled. And once they do get tackled, there's a massive amount of short covering and i.e. margin calls, and buying back silver when there is no above ground supply at current prices. So the US has come out of the gate with with no silver reserves, categorically no silver reserves, which will mean they're going to obviously heavily sanction or ban US silver exports as they seek to build stocks. However, in addition to unallocated gold bets, the Fed has also accrued a very large naked short unallocated OCC FX silver position, which will now come into Russia and Beijing's crosshairs. Well, it already is. The White House mandate to buy silver will drive another inflection point, forcing the Fed to also buy back these unallocated bets into higher prices. Now, LPs assess a realistic $140 silver price is on the cards. That is realistic. Now, we've looked at the short-term stuff, but that is a realistic price. Interesting mainstream appetite is now percolating through. We see silver and AI. We see the demand for that and the need to buy it, that ETFs are buying. I mean, this is all mainstream stuff. Silver non-commercials are forced to buy, but they're nowhere near overbought. And speaking of technically overbought, we see the same as we see in gold. COMEX actors have become price takers, with the cost to borrow silver spiking now to all-time highs. So we view pullbacks as extremely buyable. They've never been so buyable. So the exchange for physical, the basis spreads are also contracting in both gold and silver futures to spot. It indicates the physical markets are forcing COMEX to become price takers, and nearby higher rally stair steps are nearby. And it also indicates that a lot of the shorts have been chased out. So here we are with a foothold, one further stair step higher. This time with every single central bank, bullion bank, sovereign and institutional buyer divesting dollars into gold and silver. And it asks the one question that faces physical stackers. Why wait? It's simply going to cost more of your freshly printed dollars, pounds, euros, yens, etc. to buy the same ounce of gold and the same ounce of silver. I cannot wait for our next market update. See you all then.
All right, that wraps up another episode. Well said, Andrew. And, this is Live from the Vault, again, brought to you by Kinesis Money. And a big, big thank you to Andrew Maguire for sharing his deep market knowledge here, as you can see. And to you also for tuning in and being a part of this growing global community here. The word is spreading. Keep spreading the word. And if you're new here, make sure you subscribe and tap the bell right there so you'll be the first to know when we go live. So if you've been with us for a while, remember, if you can help us by keep spreading the word, give us a like right there, hit that like button right now and share this episode with someone who really needs to hear it, and get your questions into Andrew Maguire, and your question may be asked or even selected for next week's episode of Live from the Vault. And with that, we'll be back next week with more truths that you won't find on the mainstream media. And until then, buy physical, make sure it's backed 1-to-1, and we'll see you next week. Bye for now.
Don't get caught up all that double salty loving.